Why aren't you rich? You work hard. You read the books. You cut back on lattes. Yet your net worth crawls forward like it's on a diet of pennies. The blunt truth and the good news is this. It's not mostly about intelligence or effort. It's about a set of predictable psychological traps built into the hardware of your brain. They run on ancient code. They push you toward safety, toward the crowd, toward the immediate reward. Those instincts conserved your ancestors' lives. They wreck your ability to build wealth. This is a Munger-style argument. Long-term wealth comes from thinking clearly and protecting yourself against the mental errors that make the easy choice feel right. In the next 40 minutes, you'll get 7 psychological traps that keep ordinary people poor, each with a clean explanation, a short numeric example to make the cost concrete, and a repeatable system you can start using tomorrow. These are practical defenses, not promises of riches, but tools that reduce avoidable mistakes. If you want the checklist and decision journal template I'll walk through later, subscribe, stick around, and I'll lay out exact forms you can copy. Now let's get to the traps. Trap Burf 1. Loss aversion. Loss aversion is the tendency for the pain of losing to be roughly twice as strong as the pleasure of gaining. In plain terms, losing $100 hurts about as much as gaining $200 feels good. Your brain treats losses as threats. Numeric example. Imagine 2 choices. Option A, a certain $1,000. Option B, a 50% chance to win $2,000 as in $200, 50% to win nothing. Expected value of B is $100. Rationally, B is better by $100 on average. Loss aversion makes you choose A because the fear of winding up with $0 dominates the math. Consequence. You underinvest. You sell winners too early. You hoard cash that loses purchasing power to inflation. You let fear of short-term pain prevent long-term gain. Remedy, Charles system. 1. Reframe decisions in expected value terms. Before acting, write down the upside, the downside, and the probability you assign to each. If the expected value favors action, treat the pain of a loss as one-line item in a ledger, not as an absolute veto. 2. Use a loss budget. Allocate a small known portion of your portfolio for risk. Knowing you're only risking, say, 5% of liquid net worth makes it psychologically possible to accept short-term volatility. 3. Make inflation and opportunity cost visible. Convert cash sitting idle into a clear annual loss. If inflation is 3% and your cash yields 0.5%, you're losing 2.5% a year in purchasing power. Translate that into dollars across 5 or 10 years. So that's trap number 1. If you feel the pull to freeze, remember, the pain you feel now may be stealing your future. Trap number 2, herd behavior. Herd behavior is the automatic follow-the-crowd instinct. People buy what everybody else is buying because it feels safer to be with the group. But markets reward individual thinking. Numeric example. Suppose a hot asset doubles over a year. If you buy in after it's doubled, your upside is now limited. If you buy at the top and it drops 50%, you need a 100% return to get back to even. Those are ugly odds for late buyers. Consequence, you buy at market tops, you sell at market bottoms, and you confuse short-term social validation with long-term investment logic. Remedy system 1. Create a contrarian checklist. Before buying a trendy asset, force yourself to answer, what would convince me to sell? What evidence would prove this investment wrong? If you can't answer, do not buy. 2. Assemble a contrarian feedback loop. Find 1 or 2 skeptical people, not cheerleaders, and tell them the reasons you want to buy. Ask them to poke holes. Make that challenge a rule before execution. 3. Implement a buy only on disconfirm rule for trending assets. If something is popular, you require independent justification beyond popularity. Valuation metrics, cash flow analysis, a margin of safety number. So that's trapdoor 2. The crowd's applause is not the same as value. Trap number 3. Present bias. Present bias is the overweighting of immediate rewards over future benefits. The brain loves the now. A new purchase today beats a larger payoff years from now. Numeric example. Picture 2 choices. Take $500 today, or put that $500 into a mutual fund that returns 8% annually for 30 years. At 8%, $500 grows to about $5,000 in 30 years. Sacrificing $500 now yields 10 times the benefit later. Consequence, you undersave, overconsume, and underinvest. Small, repeated now pleasures compound into real opportunity cost. Remedy system. 1. Automate. Make saving and investing automatic. Set up recurring transfers timed right after paydays so you never see the money to spend. 2. Make the future real with arithmetic. Write down exact numbers. If I invest $500 per month at 8% for 30 years, I end up with roughly $500. 1,8,360, 0.08, or about $500,000. Seeing the figure bridges the psychological gap. 3. Use commitment contracts. Freeze some spending through automatic escalations that make future withdrawal harder without deliberate action. So that's trap number 3. The future wins when you force your present self to pay for it. Trap number 4. Confirmation bias. Confirmation bias is your appetite for information that confirms what you already believe and your tendency to dismiss what contradicts you. It's comfortable. It's lethal for investors. Numeric example. You own a stock and look for articles that praise it. You find 5 bullish reports and ignore 2 bearish ones. You overestimate the probability the stock will succeed because your sample is biased. This leads to concentration risk, owning too much of what you already believe in. Consequence, you double down on bad ideas, ignore red flags, and compound mistakes. Remedy system. 1. Keep a decision journal. Before you make any major trade or investment, write the reasoning, the assumptions, and the potential disconfirming evidence. Date stamp it. Revisit it later to force accountability. 2. Force a devil's advocate review. Ask a skeptic to summarize the best case against your decision. If you can't find one, seek professional or independent analysis. 3. Schedule an autopsy for big decisions. 30, 90, or 180 days after a trade, write what happened and why. Did you miss new information? Did your thesis change? This creates feedback that breaks the confirmation loop. So that's trap number 4. Your brain wants ease. Train it to practice intellectual discomfort. Trap number 5. Anchoring. Anchoring happens when the first number you see sticks in your mind and pulls every subsequent estimate toward it. Past prices, sticker prices, initial valuations, they anchor you. Numeric example. You paid $50 for a stock originally. It now trades at $20. You hang on because your reference point is $50. But the market price is $20. The past is sunk. Consequence, you refuse to accept current data and make decisions anchored in irrelevant numbers. You overpay on purchases or hold losers because you can't accept the loss. Remedy logic system. 1. Reset to 0. For each decision, imagine you have no prior investment. Ask, Would I buy this today at the current price? If the answer is no, act accordingly. 2. Replace anchored metrics with forward-looking ones. Compute expected return based on current price, not what you once paid. 3. Use a current price checklist before every transaction. Current valuation, comparable benchmarks, downside scenarios. Ignore purchase history. So that's trap number 5. The past is a ghost that haunts your balance sheet. Treat it as dead weight. Trap number 6, sunk cost fallacy. The sunk cost fallacy is the urge to continue an endeavor because you already invested time, money, or effort. It's the "I've come this far" fallacy. Numeric example. You've poured $10,000 into a project that will probably return little. To recover, you contemplate investing another $10,000. Doing so increases your total loss if the project fails. The rational move is to evaluate future expected returns alone, not past spending. Consequence: you keep throwing good money after bad. You compound losses and waste scarce capital on hope. Remedy system. 1. Decide from the margin. Make choices based on present and future expected value, not past costs. Before adding more capital, calculate the new expected value and compare it to alternatives. 2. Institute a stop-loss or stop-reassess rule. For non-speculative positions, set a point at which you pause and conduct a rigorous review, not an emotional defense. 3. Keep a failure ledger. Record projects you stopped and why. Over time, the ledger trains you to separate sunk costs from rational decisions. So that's trap number 6. The money already gone cannot be recovered by throwing more at the same mistake. Trap number 7. Overconfidence and envy. Overconfidence is the belief you're better at picking winners than you actually are. Envy drives status purchases and reckless bets to keep up. Numeric example. You believe you can pick a stock that will beat the market by 5% annually. If you understate the probability of failure and overcommit capital, a bad streak can wipe out years of gains. Similarly, spending $2,000 per month to match peers buys status now, but reduces your long-term freedom. Consequence: you take oversized risks, you concentrate bets you cannot explain, and you spend to impress, all of which erode wealth. Remedy chalk system. 1. Force humility with a 3 failure reasons rule. Before buying, write 3 clear reasons the investment could fail. If you can't, reduce position size. 2. Define sufficient. Decide what level of wealth and lifestyle is enough for you. When you define sufficiency, envy loses power. 3. Use position limits and portfolio caps. Limit any single investment to a predetermined percentage of your capital unless overwhelming evidence suggests otherwise. So that's trap number 7. Overconfidence and envy are subtle tax collectors on your future. Why knowing these traps isn't enough. You've now heard the traps. That's necessary but not sufficient. Knowledge sits in the slow-thinking part of your mind. Most of the time, you're on autopilot, reacting with fast, emotional intuitions. That's why rules beat willpower. The brain will default to the path of least resistance when stress or excitement hits. So, you need scaffolding, pre-committed systems that force deliberation when your instincts scream otherwise. Systems reduce cognitive load. They convert one-off discipline into repeatable behavior. Munger-style thinkers design these systems before they face temptation. They create a mechanical separation between intent and impulse. Here's a toolkit of practical systems you can implement this week. These are the defensive structures that protect you from your own hardware. Tool 1. The 24-hour rule. Rule: no major financial decision under emotional pressure is executed without a 24-hour pause. How? For purchases over a set threshold, you pick $500, $1,000, wait 24 hours. For trades or investment ideas outside your normal plan, wait, put it in writing. I will review this again in 24 hours with a checklist. Tool 2, Decision Journal. A decision journal forces you to capture initial thinking and later outcomes. Template: date, time, decision description. Thesis: why I'm doing this, expected outcome and time frame, key assumptions, how to prove me wrong, disconfirm in evidence, position size and risk limits. Revisit: at 30 and 180 days, document what happened and why. Tool 3, Pre-Trade Checklist. A short checklist cuts errors and anchors you to process. Sample bullets: is this within my risk allocation? What is my entry price and target exit? What would make me sell? Have I listed 3 reasons it could fail? Did I get contrarian feedback? Tool 4, No by Default. Set no as your baseline for discretionary spending. Say yes deliberately, then apply a test. If a purchase doesn't align with your defined priorities and sufficiency, decline. Tool 5, Contrarian Feedback Ritual. Before any major move, discuss your thesis with a skeptic. Make that a rule. The goal is to expose blind spots, not to win arguments. Tool 6, Failure Ledger. Record every mistake. Short entry: what the decision was, why you made it, what went wrong. Review quarterly. The ledger builds humility and practical memory. Tool 7, Loss Budget and Position Caps. Define how much volatility you can tolerate and cap single positions. Limits reduce the emotional pressure that causes irrational exits. Concrete templates and examples. Decision Journal Sample Entry. Fill-in style. Date: March 15th, 20XX. Decision: buy 2% of portfolio in Company X. Thesis: Company X will grow revenue 15% annually due to product adoption in 2 markets. Expected time frame: 3 to 5 years. Assumptions: market growth rate, management execution, no major regulatory change. Disconfirming evidence: revenue growth under 5% for 2 consecutive quarters, loss of market share to competitor Y. Position size: 2% of portfolio, max position 5%. Review dates: 6 months, 1 year, pre-trade checklist. Copyable. Is this within allocation limits? Yes, no. 3 reasons it could fail. List: entry price and target, numbers, stop loss or reassess point, price or condition, contrarian feedback obtained. Yes, no, arithmetic demonstration that makes the future tangible. People treat long-term math as abstract. It isn't. Let's make the future feel real. Example: A, a one-time $30,000 investment at 8% for 20 years. Calculation: 30,000 x 1.08, 20. 1.08, 20, 4.66. Future value: $30,000 x 4.66, $139 to $800. So $30,000 today becomes roughly $140,000 in 20 years at 8%, nearly 5 times. Example B, monthly saving of $500 for 30 years at 8%. Rough formula: monthly payment x future value annuity factor. The factor for 8% annual, 0.667% monthly, over 360 months is about 1,047. At a practical level, $500 a month at 8% for 30 years ends up around $500, $147, $500, $23, $500. Small monthly sacrifices compound into life-changing sums. Make these numbers personal. Put your real monthly savings into the formula. If the number shocks you, that's useful. The shock is your brain updating. Use it. practical day one checklist to start changing behavior. 1. Pick one trap to observe for 30 days. Write it down and set a reminder to journal each time you notice it. 2. Implement one system today. It can be the 24-hour rule or setting up an automatic transfer to investments. 3. Start a decision journal. Make one entry for any significant financial decision this month. 4. Create a first entry in your failure ledger. Write one mistake you made in the past year, what you learned, and how you'll prevent it. Why these systems work. They change your environment. They convert volatile, emotion-driven choices into slow, recorded processes. They give your future self defenses against your present self's impulses. That's the whole point, to make behaving rationally easier than behaving irrationally. A moral challenge. Accept the discomfort of being different. Building wealth in the long term is socially uncomfortable. It often requires resisting the current status norms of your peer group. You will forego some parties, not drive the latest model, and sometimes watch your friends celebrate what looks like success while you stay steady. That discomfort is the price of long-term freedom. It's not moralizing frugality. It's a simple math and behavior trade-off. Short-term social alignment versus long-term optionality. You get to choose which currency you value, applause today or independence tomorrow. Munger-style wisdom says, choose long-term thinking and design systems that make that choice automatic. Final decision architecture, how to act now. 1. Set a personal definition of sufficient. Write down what level of annual spending and net worth makes you feel financially free. 2. Choose one bias to watch for 30 days. Put a sticky note on your desk or a reminder on your phone that says the bias name. Journal each observation. 3. Implement one system from the toolkit. If you pick the 24-hour rule, create a calendar event called 24-hour review that triggers whenever you consider a purchase above your threshold. 4. Make a public commitment. Tell one person you trust what you're doing. Accountability increases follow-through. A closing storyless point. The meta law. You will not win with willpower alone. Your brain is doing what it evolved to do. Your job is not to shame it, but to out-design it. Systems act like seatbelts. They don't make you invincible. They reduce the damage when accidents happen. These 7 traps, loss aversion, herd behavior, present bias, confirmation bias, anchoring, sunk cost fallacy, overconfidence and envy, are not moral failings. They're predictable features. The difference between those who build lasting wealth and those who stall is not intelligence. It's the discipline to pre-commit and the humility to check yourself against a process. So here's the final challenge. Pick one trap to monitor for the next 30 days. Start one system from the toolkit right now. If you do nothing else, start a decision journal and make a single entry this week about a recent choice. That small act begins the discipline. If this message landed with you and you want the templates, the decision journal form, pre-trade checklist, and failure ledger, subscribe and save this video. Then take the pledge. For the next 30 days, when you feel the pull to act emotionally, consult your system first. Wealth is the product of repeated rational choices over time. These Munger-style safeguards separate those who build it from those who keep bumping into the same traps. You won't like every step. You'll feel uncomfortable. That discomfort is the currency you pay for long-term freedom. Start paying it deliberately. Start today.